Thank you, Mr. Chairman. I agree with a lot of what's been said here today. Access to mortgages is painfully tight, especially for people who aren't well-to-do, and we should find responsible ways to increase access to credit. I'm there. But once again, there are a lot of proposals that are being pitched as improving access to credit that are really about letting the mortgage industry dig deeper into consumers' pockets. And I think a good example of this is the Mortgage Choice Act. After the crisis, Congress decided that a lender could get the protection of the qualified mortgage rule only if the points and fees on a mortgage were less than 3% of the loan amount. Now, if the lender is affiliated with the title company, the cost of title insurance through that affiliate counts toward the 3% cap, which makes sense because most of the cost of title insurance is commissions, and most of that revenue is going to find its way back into the lender's pocket. The 3% cap is an important step toward fixing the broken, non-competitive market for title insurance. For other forms of insurance, not title insurance, where there is a competitive market, between 50 and 80 cents of every premium dollar goes to paying out claims. But for title insurance, according to the GAO, it is 5 cents, 1 nickel out of every dollar that is collected. The GAO also reports that more than 70 cents on every dollar is pure commission for the title agents. Subjecting affiliated title insurance costs to the 3% cap should help bring some competition and lower these artificially inflated prices. Now, Mr. Motley, as you know, the Mortgage Choice Act would blow up the 3% cap by exempting the affiliated title fee. It says that you can separate it and get money from two different sources. In your testimony, you claim that applying the cap to affiliated title insurance fees has made, quote, low balance loans serving low and moderate income borrowers much costlier to originate and consequently less available to consumers. In other words, the cap, that's the part this part of your testimony is about, is making it harder for people to get low-dollar loans. Now, I care a lot about the question about access to low-dollar loans, so I've looked closely at the data since the 3% cap went into effect last year, and I just can't find any data to support that claim. I've also asked companies to give me some data to back up the claim, but so far nobody's done that. So I noticed that you don't cite any data in your testimony, and I'd like to know what data you're looking at to support your claim.
Senator, I'm actually considering the combination of the affiliated title insurance. We had an affiliated title insurance company. With the new rule, as you have stated, we were required to include the title insurance premium. And I would disagree with you in the sense that the title insurance premium in Texas, anyway, is the vast majority of the total fees charged to a consumer. It's not a minority. It is the majority of the cost.
All I can do is look at the Government Accounting Office report on this, and that is that for title insurance, the amount that is paid out is a nickel for every dollar brought in. If you've got better data than the GAO, then please bring them in.
Okay, I will get back to you with that. But with regard to the affiliated title insurance question, I had a title insurance. We had an affiliated title insurance company for about 6 or 8 years. One of the reasons that we had that title insurance affiliated company is because we felt like we could provide better service to our mortgage customers, particularly in a refinance scenario, where I could actually meet or beat the cost of a competitor by using my affiliated title.
Mr. Motley, since we have very limited time, let me just stop you right there. I have no doubt that you can get revenue from your title insurance company and you can get revenue from your mortgage lending business. The question I'm asking is what data you have to support your claim in your testimony in which you said specifically low balance loans serving low and moderate income borrowers are much costlier to originate and consequently less available to consumers because of the 3% cap. I can't find any data to support that, and I just want to know what you're using.
Thank you. Let me say that what happens is with an affiliated title company, I've got to include those affiliated title charges in my loan origination costs. So that becomes part of my cost of fees. So at a certain level, I go over those caps.
I understand that you're not going to get as much money. The question is, why does that stop you or raise the cost? Do you have any data to support?
Well, it's not just that I may not make as much money. It's also a competitive issue, because when I look at my affiliated company and my disclosure to the borrower on my good faith estimate, my costs are going to be higher than if I used a non-affiliated company, or if someone else was comparing my disclosure to a non-affiliated company.
I'm going to take that as you have no data other than how you describe your business model on how you make money. Maybe I should just ask this.
I will get back to you with some data.
I'd be delighted to see that. Let me ask this another way. Data from both Fannie and Freddie Mac and the mortgage industry show that the average mortgage origination fees are under 1% of the loan amount. So that means for a $100,000 loan, a lender can typically charge more than $2,000 for title insurance and still be under the cap. Since claims are only eating up about 5 cents of every premium dollar, that leaves about $1,900 in commissions before you hit the cap. Isn't that enough?
Senator, you're asking me about the commission structure with title insurance companies, and I'm not involved in that business anymore.
Well, thank you. I just want to say the Mortgage Choice Act shouldn't fool anyone. The CFPB has already exempted the vast majority of smaller lenders from the QM rule, including the points and fees cap for any loan they hold on portfolio. So this is really about bigger lenders. This is about trying to get bigger fees from consumers. It's about preserving a cash cow for the mortgage industry and not about access to credit. And I urge my colleagues to oppose this bill.